$2 trillion just changed direction. No headlines, no press releases. Complete silence. BlackRock, the giant controlling $14 trillion in global assets, just orchestrated one of the largest capital realignments in modern history. And they did it while everyone was looking elsewhere. We're not talking about rumors or speculation from financial forums. We're talking about real movements, concrete positions that are redrawing the map of global wealth. And the destination of these flows reveals exactly where value will be created in the coming years. In the next few minutes, I'll show you the mechanics of this rotation, the precise destinations of this capital, why it's accelerating right now in 2026, and most importantly, how to position yourself before it becomes obvious to retail investors. Because when CNN and Bloomberg start talking about it, the easy profits will have already evaporated. Institutions will have already taken position, and you'll be buying at the top. If you want to decode capital movements before they become news, subscribe to the Econaut. Here we analyze the economics that the mainstream discovers 6 months later. Let's start with scale, because most people don't truly understand what managing $14 trillion means. BlackRock isn't a hedge fund betting on risky ideas. It's not a guru with personal hunches. It manages a massive capital larger than the economy of any nation except the United States and China. Imagine financial markets as a global chessboard. BlackRock doesn't just move the pieces, it owns the board itself. Your pension fund? Probably managed by them. Your accumulation plan? They're in it. Sovereign wealth funds, university endowments, corporate treasuries. BlackRock is everywhere. Apple, Microsoft, Amazon, ExxonMobil, JP Morgan. In every single S&P 500 company, you'll find BlackRock among the top 10 shareholders. So when an entity of this magnitude decides to reallocate capital on a massive scale, it's not speculation. It's calculated repositioning based on intelligence that costs millions to produce. Larry Fink, the CEO, has access to predictive models, demographic analysis, currency flows, and probability scenarios that no individual investor will ever see. But here's the point. We don't need access to their data. We just need to watch where they move their hands. And recently, those hands shifted $2 trillion in exposure from US markets toward emerging and international markets. Let's be clear immediately about what this means and what it doesn't mean. It doesn't mean the United States will collapse tomorrow morning. It doesn't mean you should liquidate everything and move to Thailand. It means the center of gravity for global growth is shifting. Capital behaves like water. It always seeks the path of least resistance and highest return. And right now, for the first time in over a decade, that path leads away from US equities. Here's what separates institutional from retail investors. Timing. Retail investors react to news. They see a headline, feel emotions, buy or sell driven by fear or greed. They're reactive. Institutional investors move before the news exists. They position on forward-looking indicators, not backward-looking headlines. And when financial media explain a trend to the general public, that trend is already crowded. The alpha, the excess return, has already vanished. So the real question isn't whether US markets are good or bad. The question is, where will the next wave of growth come from? And how do I position before everyone else figures it out? Let me show you the math behind this rotation. Once you see the numbers, the logic becomes inevitable. In 2025, the US dollar lost significant value against a basket of global currencies. When the dollar weakens, your purchasing power drops. Even if your portfolio stayed flat in nominal terms, you lost real wealth because those dollars buy less. Now look at how global equity markets performed in 2025. Germany's DAX returned about 22%, Japan's Nikkei about 26%, the MSCI Emerging Markets Index nearly 30%, the S&P 500 about 16%. 16% is a great result. Nobody complains about positive returns. But when you compare it to the 30% you could have earned in emerging markets, you realize you left 14 percentage points on the table. This is the opportunity cost of home country bias. And here's where it gets even more powerful. When the US dollar weakens, foreign investments get a currency tailwind. You profit two ways simultaneously. From asset appreciation and from the foreign currency strengthening against the dollar. A double return. Practical example. You invest $10,000 in a Japanese stock. The stock rises 10% in yen terms. Normally you'd make $1,000, right? But if the yen also strengthens 8% against the dollar during that same period, you don't just earn 10%, you earn roughly 18% stock return plus currency gain. This is why weak dollar cycles create enormous opportunities in international equities. You're not just betting on companies, you're betting on currencies. And right now, both tailwinds are aligned. Now let's address the elephant in the room, because I know what you're thinking. Aren't international markets riskier? Aren't emerging markets unstable? It depends on your time horizon. Over short periods, yes, emerging markets can be more volatile. But over long periods, 10, 20, 30 years, the data is clear. Emerging markets have outperformed developed markets because they have the one thing developed markets don't have: demographic growth. The United States, Europe, Japan have aging populations, birth rates below replacement level, shrinking workforces. Emerging markets like India, Brazil, Indonesia, Vietnam have young, expanding populations. Young people work, spend, consume, build. This is economic growth, and capital always flows toward growth. But here's the problem many investors face. You don't know which country to pick: India, China, Brazil, Taiwan. If you get it wrong, you can lose heavily. This is where the basket approach comes in. Instead of trying to guess the winning country, you buy a diversified fund that contains them all. And this brings me to the 3 specific ETFs that are capturing this capital rotation right now. First ETF, VWO, the Vanguard Emerging Markets ETF. VWO gives you exposure to the fastest growing economies on the planet: China, India, Taiwan, Brazil, South Korea, and others. Why does this matter right now? Demographics. These countries have young, expanding workforces. The median age in India is 28. In China, it's 38. In the United States, it's 48. Young populations fuel economic growth. Last year, VWO returned about 25%. This year, price action has been choppy, consolidating. But for smart investors, consolidation is positive. It's not a bug, it's a feature. Institutions don't chase assets when they're screaming higher. They accumulate during quiet periods when retail investors are bored and looking elsewhere. Buying VWO today is like buying the S&P 500 in 2003. It's not a quick flip, it's long-term exposure to the next economic superpowers. Second ETF, EWJ, the iShares MSCI Japan ETF. This one surprises many people. Japan? Isn't Japan's economy dead? Isn't it the land of lost decades? If you still think that, you're looking at old data. The new Japan is fundamentally different. It has undergone massive corporate governance reform. Companies now prioritize shareholder returns, buybacks, increasing dividends, greater efficiency. Plus, the yen has been weak, making Japanese exports cheaper and more competitive globally. Companies like Toyota, Sony, Mitsubishi are generating record profits. Last year, EWJ returned about 24%. At one point this year, it was up over 70% year-to-date before pulling back. Is the run over? Maybe. Or maybe this is just a pause before the next leg higher. Here's what I know. Institutions love Japan right now. Stable government, world-class companies, currency tailwind, market finally focused on profits. Third ETF, iShares, MSCI Emerging Markets, ETF. This is the broadest emerging markets fund. It returned 34% last year. I'll repeat that. 34%, while the S&P 500 did 16%. This is the tool institutional investors use when they want to make a macro bet that global growth will accelerate faster than US growth. They're not just betting on India or just Brazil. They're betting the entire developing world will outpace the United States. And right now, that's a very smart bet. If you believe the next decade belongs to emerging economies, you buy this ETF and let it compound. Now I need to address the psychology of this moment because understanding investor psychology is more important than understanding fundamentals. When you see headlines about sell-offs, when you see Trump tweeting about Greenland or tariffs, when you see drama at Davos, your instinct is panic. Your instinct is to sell, preserve capital, wait for clarity. That instinct will keep you poor. Here's what you need to understand. People panic. Institutions reposition. Money doesn't leave the market during sell-offs. It simply changes hands. It moves from weak hands to strong hands. Pullbacks are just the big players moving chips from one table to another. And here's the rule you need to internalize. Every major capital rotation feels uncomfortable before it feels obvious. Read that again. It feels scary and uncertain right before it becomes evident to everyone. In 2009, buying US stocks felt terrifying. The financial system had just collapsed. Banks were failing. Unemployment was spiking. It felt like the end of the world. But institutions were buying aggressively. And if you bought in 2009, you made over 400% in the following decade. In 2020, buying during the COVID crash felt insane. The economy was shut down. Nobody knew what was happening. But institutions bought. And if you bought in March 2020, you doubled your money in 18 months. The pattern is always the same. Maximum fear equals maximum opportunity, but only if you're positioned before the fear subsides. Now let me show you the massive mistake 90% of investors make during rotations like this. They wait for certainty. They wait for the news to say everything's okay now. It's safe to invest. But certainty is the most expensive thing in the world. Certainty only appears after the returns have already disappeared. BlackRock isn't waiting for certainty. Larry Fink doesn't have a crystal ball. He has probabilities, data, and the conviction to act when probabilities favor a specific outcome. If you wait for the all-clear signal from CNBC, you're buying at the top. When the water looks clear, the big fish have already swum away. Now, does this mean you should dump all your US stocks and go 100% international? Absolutely not. I would never tell you to act out of fear or make extreme binary decisions. This is about balance. This is about recognizing that leadership in global markets is rotating. You don't abandon the US, you simply allocate appropriately. There are US sectors still strong. Defense, rare earths, industrials. These are safe harbors in the American market. But ignoring a global capital rotation when the largest asset manager on earth is moving $2 trillion, that's the real risk. You don't need to predict the future. You just need to follow the footprints. Position early, stay patient, let compounding do the work. But there's another shift happening that connects directly to this capital rotation. It involves gold and silver. This isn't just about prices going up. This is about a fundamental change in how the global financial system values these assets. Recently, under Basel III banking regulations, gold has been reclassified as a Tier 1 liquid asset. For decades, banks treated gold like a decorative piece. Nice to have, ornamental, but you couldn't use it operationally. It just sat in vaults doing nothing. But now, under the new rules, gold is treated as equivalent to cash. Banks like JP Morgan, Goldman Sachs, HSBC can now count physical gold holdings as 100% liquid capital. They can use it as collateral. They can leverage against it. They can use it to meet capital reserve requirements. Suddenly, gold isn't just a safe haven. It's a financial tool. And when the world's largest banks realize they can use gold to expand their balance sheets and create more lending capacity, what do? They buy more gold. This is why we're seeing gold hit all-time highs above $5,000 per ounce in early 2026. It's not just fear driving the price, it's utility. Gold is now part of the core financial infrastructure. And what does this mean for you? BlackRock, the institution managing your 401k, is positioning for this. Whether you personally own gold bars or not, this regulatory shift impacts the value of your retirement accounts. Because the institutions managing your money are reallocating based on these new rules. Now let me show you the panic playbook, because understanding this will save you from emotional mistakes that destroy wealth. We've seen this pattern before, especially during Trump's first term. Notice how bad news always drops on weekends. Why? Markets are closed. They want you sitting at home Saturday and Sunday, stewing in fear, reading scary headlines, imagining worst-case scenarios. By Monday morning, you're terrified. You sell. The market dips. Institutions buy your shares at a discount. Then Tuesday comes. The EU threatens retaliation. Trump doubles down. It feels like World War III is starting. But quietly, by Wednesday or Thursday, you hear rumors. Negotiations are ongoing. Talks are productive. Progress is being made. And what happens? The market rallies. The crisis evaporates. And the institutions that bought your panic-sold shares on Monday are selling them back to you Friday at a profit. This is a game played entirely on your emotions. And if you know the playbook, you don't have to be the victim. Notice we're now 3 cycles into this tariff drama, and we still haven't heard specific legal details about implementation. That's not an accident. They're keeping it vague on purpose to maintain uncertainty. Uncertainty creates volatility. Volatility creates opportunity for those who stay calm. Here's what you need to do. Close the app. Seriously, stop checking your portfolio 47 times a day. The constant stimulation, the flashing red numbers, the breaking news alerts. It's all designed to emotionally hijack you. The system wants you panicked, so you make irrational decisions. Wealth is transferred from emotional investors to disciplined investors. That's how the game works. You need to resist the urge to react. Calm down, do research, create a plan, execute the plan, then walk away. But knowing not to panic is only half the equation. You also need to know exactly what to buy when everyone else is paralyzed by fear. The 3 ETFs I just gave you, VWO, EWJ, and EM, are the core plays for this global rotation. But there's one specific sector that historically thrives during geopolitical chaos. It's not tech. It's not real estate. This sector outperforms the S&P 500 by double digits whenever global tensions rise. And institutions are pouring billions into it right now as we speak. If this analysis showed you a capital rotation you didn't know was happening, subscribe immediately to the Econaut. BlackRock just moved $2 trillion. The question is whether you move with them or stay stuck in yesterday's winners. The choice is yours.